Hello students, this video clip will cover the part 1, the building assumptions and schedules with the basic info, and 10Q for the final project master budget a quarterly basis for Apple cases. The final project Excel part is comprised of part 1, the assumption and schedule, building the schedule part, and part 2, the master budget with the schedules. That means that you will construct budgeted income statement and cash flow statements, and then the budgeted balance sheet where you see the cash balances and all the financial performance. Okay, so first of all, we need to build a sales budget assumptions, right? We need the September sales, which is the actual, and then budgeted monthly sales. All projected sales must be based on the research. I put this the October, November, and December of Apple cases based on the assumptions. The last month's $12.1 billion now increased more and decreased, something like that. But those numbers should be explained by your research in your chosen company. And then you'll be given that sales mix, which is cash and credit sales. 20% of cash sales and credit sales is 80%. And then this 80% of the credit sales will be collected for the following month. And then when you set up this September or your last quarter, the sales, last month of the quarter, the sales, you can just assume the average monthly sales by calculating actual quarter sales divided by 3 so that you can get the last month the sales. Then the budgeted the purchase and cash disbursement, as we learned in the classroom, the minimum inventory policy, all the companies has those kind of policy. If you found this policy in percentage in the 10Q or somewhere, and then you can use, but you can just simply assume 40% of the next month's cost of goods sold is the minimum inventory policy. And then this is important. The gross profit rate is important in that you will be able to calculate cost of goods sold from this gross profit rate, because 1 minus 100% is the sales. 100% minus 43% is going to be now the cost of goods sold, right? Then how do we calculate the gross profit rate? Yes, from the last quarter, right? The gross margin over net sales, then you will get the gross profit rate, and then you will apply this rate in order to calculate the cost of sales in schedules. And then the monthly purchase is 10% for the cash payment when this company purchased the inventory, and then month after purchase and 90%. We assume this percentage in your company cases as well. And then budgeted expenses, the research and development and selling and general administration and other income or expenses, we use as a percentage of sales. Why? Because all the expenses here is the part of the activities of the quarter. And then in this vertical analysis, the base is always the sales, right? The sales. So we calculate this research, all the expenses. If you have different name of account on the income statement, then you can just build more lines on it, okay? And then depreciation. How do you get the depreciation? I got this depreciation information from 10Q, where I put the depreciation, and then I found the depreciation of the last quarter, $8,295,000,000, right? And then I found that depreciation is actually 9 month ended. That means that this depreciation is accumulated for 9 months. So we have to divide by 9 in this the Apple case. So 8,295 divided by 9 months, so that I got the depreciation in monthly basis. Okay, once I build this part 1 assumption part and then collect all the financial statements from 10Q in actual, the last quarter, and the balance sheet as well from 10Q here. And then let's get started to construct the schedules. First, credit sales and cash sales. How to get this credit sales, right? Here we go. On October, this amount times 20% or 80%. Yeah, 80% is the credit sales. And then November, also the same way. And December, the projected the sales times 80%. And then cash sales is October times 20%. And then cash sales of November is 20%. Oops. And then finally December, 32,000 times 30%. So we have the cash sales amount and the credit sales amount in each projected, the budgeted month, right? And then sum of these two types of sales. Now we have, and then let's also calculate the sum of these 3 months, because at the end of the day, we will transfer this the quarter total into where, right? The budgeted income statement quarter total and each month, right? Then sum of these 3 as well. And then also the same way. Then we got it. So all this, the sales, total sales amount should be same as what we projected here on the assumption part, right? Yeah, that's correct. And then the cash collections. So this is sales budget has 2 purposes. First, to create the financial the financial statement of income statement. Second, we want to create cash collection cycles, with which we will create the cash statement, cash budget statement, right? Okay, the cash sales. Cash sales is the cash sales incurred at the right month, right? So we just correlate this. Then we got all this number, right? The cash sales amount. Then collections from prior month. Collections from prior month is, how to get it? Yes, we have this September sales, the last month, right? Last month times how much percentage, right? Here you go, the 80% credit sales, right? The credit sales of the September. Now we collect the cash on October, right? How about November collection from credit sales, prior month, right? There you go, credit sales. Now you can just correlate. Then credit sales. Let's got it. And then the sum of these 2 cash collections and collections from prior month. Then we got these numbers, right? So you may find this the total sales and then total collection from the sales has different amount, right? Especially November sales is 29 billion, but actual cash collection is 24 billion. So you have to manage the actual cash amount on hand in order to avoid some cash shortage. December as well, you got the total sales 32 billion, but actual cash collection is 30,000, right? So you have to explain the cash management skills on the water part in terms of comparison between at the total sales and the total collections. Okay, and then the total, I got this total collections for the quarter is 85, the 76 billion, but wow, there's huge difference, right? So you need to manage the cash collections, the management through this budget. Now the purchase budget also the same process as we did in the sales budget and cash collections. Desired ending balance as indicated here on the assumption part, the minimum inventory policy as 40% of the next month's cost of goods sold. So we need to calculate cost of goods sold first, right? Then it's now easy because all the cost and expenses on the income statement is calculated based on as a percentage of sales, right? So the plus cost of sales on October is total the sales. Now, what is the percentage of cost of goods sold? Right, 1 minus here, gross profit, gross rate, right? Gross profit rate. Then I want to fix this rate because I want to drag to the right side. Then I calculated all this, the total, all this, the minimum, the inventory desired as in the ending inventory. To calculate desired ending inventory, first I calculate cost of goods sold or cost of sales. And then desired ending inventory calculation, the minimum inventory policy as 40% of the next month, right? 40%. Now let's apply 40% of the next month cost of goods sold. Then on the November minimum inventory, ending inventory is now how to calculate it, right? Again, the 40% times, right, the cost of goods sold next month based on the assumptions. Then how to calculate the December? It's a little bit challenging. Still 40%, we need 40%, right? And then times how to get the cost of goods sold. Because cost of goods sold is how to calculate the cost of goods sold of the January. Because when you measure the desired ending inventory as a minimum inventory balance, we use the next month's cost of goods sold. That means that we need the sales of the next month, which is the January, to calculate the January cost of goods sold. So where is the January sales? There you go. January sales. Then times 1 minus, right, 43%. And so that we got the cost of goods sold on January. Then just multiply 40%. Then we got the December, the desired ending inventory following this minimum inventory policy, right? So once we got these two numbers, the ending inventory and cost of goods sold, these two numbers are total inventory needed, right? And then the beginning inventory. Now we need to subtract the beginning inventory to get this total purchase. Where do we get this beginning inventory? October beginning inventory, right? There you go. Beginning inventory here on the balance sheet of the last actual the quarter, right? And then beginning inventory of the November is the ending inventory October. The same way also the November ending inventory is the beginning inventory of December. Then let's get all this number into the total purchases. So total needed minus the beginning inventory, and then we got the total purchases. Then let's calculate quarter total. Sum of these three number. Then it's the same way. Sum of this number. Then okay, let me just copy and paste, or just drag down, so that we collect everything. But I don't want this underline this part as well. Okay. Now let's move on to actual cash disbursement from this purchase. Okay, we have to start for September purchase, because September part of the September purchase is paid right on October. So where do they start here? Right, on October September purchase, how much is that? How much is the September purchase? Where is the September purchase amount? We don't have the September, which is actual amount of the credit purchase. Where do you get it? Right, here you go. Accounts payable, $40 billion on the balance sheet in actual is the starting point, because accounts payable is the cash to pay, right? The company deferred this payment to the next month, which means 90% of the purchase on, right, the September. And how much is the October purchase? Right, it's now we have this information on the schedule. The October purchase times how much percentage? 10%. The company paid right away, right? On November, this amount times 90%, rest of the purchase will be paid. In the same way, the November purchase, now we use same the 10% of that month purchase, and then November purchase of this 90%, right, will be paid. How about the December one? December is December purchase times, right, 10%, right? So the other part should be now, yeah, 0, not necessary to relate it to this total disbursement part. So let's just sum those up, then drag to the right. Then total total amount is just the sum up again. Then got that information. So total disbursement 41, and total purchase 14, and total purchase, the November purchase and the disbursements are different, right? Totally different. Especially on October, you should be careful, right? Because actual disbursement, the payment, is greater than the purchase. Yeah, I know it's a little bit unusual cases, because we have different assumption from actual companies, the plan in this case. But that doesn't matter. The main purpose of this budgeting, the exercise, is to learn how to create the budgeting schedules, and then how to convert these budgeting schedules on the financial statements, the balance sheet, budgeted balance sheet, cash flow statement, and the income statement. Okay, and then finally schedule the operating expense and disbursement. So we have an assumption here: all the expenses and depreciations is not actual the payment, but we will extract this depreciation from the expenses, so that we get the disbursement from operating expenses. All the expenses incurred at the right month, right? So How do you calculate it? Now we'll correlate this percentage now to the projected the sales. Then let's drag it to the right. So we calculate it. And then the general selling general and administrative is 6.65%. We already calculated, and let's lock that cell and sales also. And then let's drag it to the right. Finally, other income and net amount is now calculated also same way. Here 0.3%. Let's lock the cell. We are going to use that percentage all the way through those months. And then let's drag to the right. Okay, then we need to be careful in these non-cash expenses. Depreciation expense is not showing on the statement operation income statement on a separate account. There's no separate depreciation account because it is included in this research and development and selling general and administrative expense. That's why we have to extract this depreciation from 10K information, right? 10K, we got this, the depreciation. So 922, and then the same way, we have the same amount, right? Same amount. And then total disbursement of operating expense is now, you should be careful now, this now plus this, oops, plus this, and then you should subtract depreciation, right? So that we got the total disbursement. Total disbursement of depreciation, except for the depreciation, right? And then let's drag it to the right. Just give me a second, and then, oops. Okay, and then let's just sum those up to the same calculations, and then we got all this disbursement part. Okay, and then the next video clip will cover, so we actually miscalculated this part because the research and development and selling is the general administration was the positive, the expenses, but the other income is the positive, which is the income net amount, right? So we need to get this number, which is negative, right? Okay. Then we have corrected number here. Okay, you guys, see you on the next video clip for the part 2, the master budget with schedules to complete the budgeted income statement and cash budget and the budgeted balance sheet. See you guys. Bye bye.